December 1st dawned under a haze of uncertainty, the global cryptocurrency landscape shifting in a sudden, drastic motion. Markets awoke to the shock of Bitcoin breaking violently below the $87,000 threshold, erasing $150 billion in value practically overnight. The catalyst? A surge in Japanese government bond yields that sent tremors far beyond the island nation, the ripple effect jolting global macro-sensitive assets. Bitcoin's order books, stretched thin by weeks of speculative fervor and cautious sidelining, revealed an underlying fragility, one unable to resist the macro shock. Such sharp moves exposed how crypto liquidity remains a delicate veneer, easily punctured when panic outweighs conviction. Within institutional corridors, the closing scenes of November did little to inject confidence. Spot Bitcoin ETFs, once heralded as a bridge to mainstream legitimacy, ended the month battered, though salvaged by a late $70 million inflow. The numbers masked a deeper discomfort. Flow bands fluctuated unpredictably as December began. Volatility was heightened, liquidity pools were shallow, and the gravitational pull of Federal Reserve policy loomed large. For many ETF traders, the threat of another liquidity crunch hung over the market like frost, every trade weighed against the caprices of macroeconomics rather than clear conviction. If macro instability threatened trust in prices, operational security tested faith in platforms. News rippled through trading desks that Upbit, among Asia's leading exchanges, suffered a $36 million loss after hackers pierced their hot wallet defenses. As trading bots and retail investors watched token order books contract, the industry's quiet anxiety over insurance resurfaced. Yes, Upbit pledged to reimburse affected balances, standard practice since the landmark hacks of yesteryears, but the immediate drying up of liquidity was palpable. Market depth faltered, spreads widened, and a sense of unease tainted even those whose assets were untouched. Reminders that exchange insurance cannot retroactively stabilize market structure or cushion the blow to immediate liquidity pressed traders to re-examine risk management anew. Zooming out reveals a paradox: the ecosystem has never been more valuable, yet faith in its foundational rails is brittle. The global crypto market cap rests at $2.89 trillion, with $150.34 billion churning through in a single 24-hour cycle. Bitcoin still commands dominance, 58.6%, but its price, $85,358.46, flits nervously in hallways of fear. Ethereal optimism lingers around Ethereum at $2,783.58, and sectoral performers, like the prediction sector rising 11%, briefly offer respite from the storm. But the broader sentiment is unmistakable. The Crypto Fear and Greed Index, registering an extreme fear of 24, underscores a market searching for stability amid discordant signals and persistent vulnerabilities. Market participants, hedge fund managers, yield farmers, small-scale traders, find themselves in a narrative defined as much by psychological thresholds as by numerical ones. Panic, skepticism, and fleeting optimism chase each other through the order books. Above it all, analysts and influencers debate the shape of this new paradigm, the next memecoin supercycle, broader cross-chain integrations, technological shifts that might finally resolve the perennial contradictions of liquidity, security, and velocity in decentralized markets. Against this tableau, the December story is not merely one of lost billions or battered charts but of communities testing the true resilience of their faith. Each shock, each hack, and each macro event chisels away at old certainties and demands a recalibration, not just of portfolio allocations, but of the psychological contracts that underwrite the digital asset revolution. The coming weeks will test whether conviction can outlast volatility, and whether, beneath the surface, the infrastructure of crypto is strong enough to preserve its vision in the face of persistent uncertainty.